All right, everyone. Well, thanks for joining on another Wednesday night to talk about underwriting. No, it's not the most rah topics that gets everyone all fired up, but I appreciate you guys for being here, and hope I can let you guys walk away with something from today's session with some value. So for those of you who don't know me, my name is Victor. Myself, Trevor, and Marcel, we're the core members of the Multifamily Freedom Chasers, or the Freedom Boys that we're known as. I'm a pharmacist by training and work a W-2 in the pharmaceutical industry as a drug safety scientist. Like Marcel and Trevor, I'm married and also have 2 kids. If this is the first time that you guys are joining one of my underwriting Zooms, put a one in the chat. Just wanted to say welcome, or just to see if there's any new faces, or is everybody a returning member here? Oh, hi Lois and Renee. Welcome. So just a quick shameless plug. If you guys haven't already, please plug into our ecosystem. You can join our Multifamily Freedom Chasers Facebook group. You can follow us on Instagram, like and subscribe to our YouTube. Let me post some of our social media here into the chat. Okay. So I had filmed a 3-part series on how to get started in multifamily underwriting a few months back. And the last couple sessions of underwriting the market is also uploaded onto our YouTube, along with the recordings of all our other Zooms, as well as our Sunday Zooms, our Monday Broker Talk Zooms, etc. So if this isn't your first time, thank you for coming back and maintaining that student mindset. I'll say this every single time. That's a mindset that we should all adopt, which is to become a student and to remain a student. The world is always changing, so we must always be willing to learn. And then as we remain students, become a contributor. Take those things that we just learned and contribute back to the community. Help those that need help with the information that you just learned. And as a result of becoming a contributor, naturally you become a leader. And you see that in our Freedom Chasers ecosystem and our community leaders. Peter St. Martin, Eddie Charger, Ed, the Miles family, Jerry and Shelley, and we just recently appointed 2 new leaders, Aldo and Will, who just hosted the Napkin Underwriting Zoom yesterday. And they did a great job. Did anybody join in yesterday's napkin underwriting session? Put some fires in the chat if you guys went to yesterday's Napkin Underwriting Zoom and thought that it was a great Zoom. So just trying to give you some love here, Will. So yeah, you see that in our Freedom Chasers ecosystem. We try to get you activated on Sunday night with our activation Zoom. We bring on guest speakers to get you pumped up, to jumpstart your week. And then we have broker talks on Mondays with Peter to help you guys find deals. And then we have napkin underwriting on Tuesdays for after you get your deals from the broker, so that you know how to analyze it quickly and efficiently to see if it's a deal or no deal. And then alternating on Wednesdays, we have the financing and debt market Zoom to help you understand how to structure loan terms to finance those deals with the Miles, with Jerry and Shelley. And then, of course, today's advanced underwriting Zoom right now, with some advanced topics. So remember, the greatest leader isn't always the one that goes on and do the greatest things. They're the ones that get the people to do the greatest things. So we want everyone here to become contributors, and eventually leaders, so that collectively, everyone together can do bigger and greater things than we can ever do on our own. So it's our vision to be able to help activate and propel 100,000 working professionals in their multifamily real estate journey, in active and passive investing, so that they can acquire financial freedom to be able to spend time on what brings them purpose, meaning, and joy. Right. So as you would expect from a Freedom Chaser Zooms, because we all come from the corporate world, here's our agenda of what we're going to do today. So we're going to keep this to an hour only. We're going to go over some quick housekeeping, and then we'll go into the content for today. And then it wouldn't be a Victor Zoom if I didn't leave you with some homework, right? So there's got to be some actionable items for you to take away with. And then finally, we'll close out with some Q&A. So housekeeping, we're a collaborative community. Please, everyone, put your contact information in your chat and in your name, and then also your target markets, so that we can all network. Unfortunately, we'll keep everyone muted at the beginning because there's been some unfortunate instances, people doing inappropriate things. But raise your hand, and then and you can always unmute yourself then. Turn on your camera if you can. We'd love to see your faces. And just be mindful of each other. Be active in the chats, asking questions, answering other people's questions if you know the answer to. All right. So content for today, we'll call it Underwriting the Market 301. So during the last session, we went over what are the KPIs of a market. I briefly introduced them last week. So just a recap, I like to look at the key performance indicators, KPIs, in different categories, which is past performance, present performance, and future performance. So last time I went over past performance KPIs, and that's your employment trends that you can compare to the national average. And alongside that, employment diversification. So does the market have a diverse set of employment sectors, or is it a one-trick pony? We don't want a one-trick pony. And then the other past performance KPI is competitive advantage, where you can do a shift share analysis and compare specific regional industries in your market and see how it compares nationally over any period of time. Again, the replay of the last session was recorded on our YouTube. So if you guys if you guys want to watch it over again, you hop over to our YouTube. And then present performance, you have demand and supply, which is what is the current demand for units based on population metrics, and what is the supply of units in that market to see if there's a gap or oversupply. Then you have your market cycle. So in what quadrant of the market cycle is your market in? Is it in the recovery, expansion, hypersupply, or recession? And this is driven by demand and supply. And then lastly, future performance, where you can calculate the future population growth and rental demand growth by doing an economic-based analysis. So remember the questions that you should know the answer to if you're an active investor, or the questions that you should ask sponsors if you're a passive investor. These questions can be answered by determining and calculating all of these KPIs. So today's goal, what we're going to go over, present performance KPIs, which are demand and supply and market cycle. So understanding these two concepts is really important because this information directly ties with our underwriting assumptions, especially for the first year or two for our projections. So for anybody that's joined in our last session, does anybody remember what is demand and what is supply? Why don't you guys put it in your chat if you guys think you guys know, or if you guys remember what demand and supply is. So it doesn't seem like anybody remembers, but so demand is people. So the people is what drives demand of units. And supply is space. So in our case, in multifamily, that's the number of units. So when we talk about demographics, psychographics, that's people. So people need a place to live. People need space to run their business. People need to buy land to invest in the future. So demand is people. So if you were here for the one-on-one sessions a couple weeks back and you did your homework, which was to research the population data on Census Quick Facts for your market, you would actually already have the data you need to calculate demand. Okay, so present KPIs. So how do you do a demand supply analysis? So when we're calculating current demand in a certain market, what we want to do is we want to take the total population, which we can get from the census, and then subtract from that the group quarters, and that will give us our household population. So group quarters, that will be things like prison, on-base military housing, on-campus student housing, things like that. So those are considered group quarters, and they're considered non-household population. So we have to subtract that non-household population, and that gives us the total household population. We then take that total household population, and then you can divide that by the number of people per household. And all of this information we can get from the census. And then that will give us our total housing units needed based on this population. So keep in mind, this is owned and rented. So to find out the rental demand, you would need to find the tenure, which is your owner-renter ratio. So if you multiply out what that renter ratio is, then that will get us down to the number of rental units required for the total population. And that's all rental units, single family, multifamily, all of it, all rental units. So we also don't want a market that's 100% occupied. So, so if you get new jobs coming in, we have nowhere to put them. So we want to factor in a vacancy allowance. So we get that by looking at the long-term occupancy average of that market. So you divide the total rental units required for the total population by the long-term occupancy average, and that will give you your total rental demand in your market. So does anybody have any questions about this? I'll take no hands as you guys understand it all. So once you guys have your demand, you can look at your supply. So remember, as I said, calculating supply, that's space, so which is units. So you can take the total number, take the total number of units that's currently in the market, then you add the number of units that's under construction and also the number of units that are proposed, and then subtract out the number of units that are being demolished. So, and then that will give you your total supply. So the total supply information you can get from supply data, like a data source like Costar. So then to calculate, to do the demand and supply analysis to see if you have a gap or supply, you would take your demand and you take and then subtract out the supply, and then that will give us whether you have a gap or supply. So again, you can find this the supply information from a supply data source like Costar. You can pay to get access to it yourself, but that's really expensive. Or this is where we like to do, we want to make relationships with people in the industry, and which is really important for your business, to build a relationship with somebody who does, like a broker or a property manager. So this is a snapshot of the type of information you can expect from a data source like Costar. So you can get you can find data like the total inventory of units online, how many units are under construction, the absorption of units. This is a key indicator of the trend in the demand of units. So absorption is the difference in the number of occupied units over a specific time period. So you take the ending number of occupied units and you subtract out the beginning number of occupied units, and that's your absorption. And what you want to do is you want to compare the absorption with the number of new construction units being delivered during the same time period, and to see if it's keeping up with the number of new units being coming online or not. So Costar can also give you the current vacancy rate, the cap rate, and also the long-term occupancy average, and so much more information. I'm not a sales rep for Costar, by the way. I don't even have access to Costar, but I know somebody who does that helps me get this information. So, who thinks that this is the type of information that you would need when underwriting a deal? You think that this is just a little bit important or really important? So this is extremely important, and this is actually market specific information. And a lot of people tend to use just, rules of thumb, or just making up a projection and not knowing what the market actually is allowing for. But you really want to find supply side information through supply side data source like Costar. I do see a hand up. Is this Jael?
Hey, sorry, not JL. I'm her husband, but
Oh.
I'll put my video on real quick. So is the market cap rate, is that just an average of the ones that have sold?
So this is, so this will be whatever information that they have. So what the market cap rate is for the properties that have sold.
Okay, so yeah, they just take the average then.
Yeah, so it's an average.
Okay.
So it's a very fluid, it's a very fluid number.
Yeah. That's all.
Okay.
Hey, Victor, on those supply and demand metrics, are there like standards that you should look for when evaluating? I don't know if there's like a certain like number that you should see when you're calculating those.
So obviously having a gap, meaning you have more demand than the number of units available, that means it's a strong market. That means it's going to be an emerging market. And having an oversupply means it's starting on a downward trend, which I'll talk about later. But for a very quick snapshot of how things are working currently, you want to look at the absorption. You want to look at the absorption, which we can find in something like Costar, and compare that to the number of units that are coming online. So if you have more units being absorbed than the number of units that are coming online, that means slowly you're filling more units than that are coming online. So vacancy will start decreasing, occupancy will be increasing, and in that kind of environment, you'll see rent growth. If you have oversupply, then that starts to look the other way. You'll have more supply than demand, and you'll start seeing rent concessions and decrease in rent growth. So there is no rule of thumb, or what thing that you want to target for. You have to understand the trend of the market. Did that make sense?
Yes, thank you so much.
Okay, so you guys can go through this and see if you guys can calculate it yourself, and put the answers that you guys get in the chat. So if you have a total population of 116,000, you have group quarters of 1,000. In this particular market, you have 2.5 people per household. You have a own to rent ratio of 68%. Keep in mind, own to rent. And then the long-term occupancy is 93%, so a vacancy allowance of 7%. For interest of time, I'll go over this now. So I gave you the equation here. So if you have 116,000, you want to take out the group quarters. So your total household population will be 115,000. So you want to figure out number of households. So you divide that by the number of people per household. So divide that by 2.5. And then you'll get a total occupied housing units of 46,000. Then you want to divide out by the tenure, which is the renter ratio. So your own to rent ratio is 68%. So what's then the opposite of that will be the rent ratio. So that will be 32%. So you multiply the 46,000 by the rent ratio, which is 32,000, and you get a occupied rental units of 14,720. You want to divide that by the long-term occupancy average, so which is the 93%, which is the 1 minus the vacancy allowance of 7%, so 93%. So you have a total rental demand of 15,828 units. So next, let's calculate supply. So if you have the total number of units in the market is 14,000, you have 200 under construction, you have another 100 that's being proposed to be constructed, and then you have 50 units that's being demolished. So let's calculate the supply for that market. So here we go. So the total number of units in the market, you have 14,000. You want to add the number of under construction and proposed, and you want to subtract out the numbers that's being demolished. So you have a total supply of 14,250. Okay. So then you want to see if you have a gap or oversupply. You have a rental demand of 15,828. Total number of units of 14,250. So what is this, a gap or is this an oversupply?
Gap, right?
So then, yep. So this is a gap. So you have a gap of 1,578 units. So that's what you like to see in a market, because that means this is still a growing market. All right. Any more questions about demand and supply?
Yeah. Does this take areas that have student housing into account? Because students come and go and they just don't settle. I'm sorry, I joined late. So if you already mentioned this, I will go and watch the beginning. Sorry.
Yeah. So I did go over this. So yes, the calculating total rental demand, it does take into account group quarters. So quarters that's like your prison population, your on-campus student housing, on-base military population as well. So you want to subtract that out from total population.
Oh, got it. Cool. Thank you. Thank you.
Yep, because that's non-household population. All right. So then let's move on to market cycles. So has anybody heard what a market cycle is?
Kind of.
Okay. So real estate pretty regularly goes through cycles of boom and bust periods, just like any other kind of investment. So these cycles can be broken into 4 phases: recovery, expansion, hypersupply, and recession. So here's what a cycle looks like in picture format. So some of you guys may have seen a diagram like this before. So this is a version of a real estate market cycle. So this line running through the middle here, this represents the long-term occupancy. And this y-axis here this essentially can represent your NOI. So phase one starts in recovery, then you move over to expansion, and then you'll end up in hyper or oversupply, and then go back down in recession, and it cycles over again. So looking at it very broadly, so you have a relatively slow upcycle from recovery and expansion, and peaking and expansion. And when it peaks, it can very quickly decline through hypersupply into recession. Okay, so phase one recovery. So at the start of recovery, you're in a state of a lot of oversupply due to too much new construction from the previous period and a decrease in demand. So this means that you're at the lowest occupancy rate and in turn the highest vacancy rate. So when the market hits rock bottom, that's when all the construction from the previous cycle stops. There's no construction going on. Nothing is starting. Projects that started stops mid-construction, and this starts the start of recovery. Then demand starts to grow. Slowly fills up the excess supply of vacant units. There's still very little to no construction going on right now. And then as vacancies get filled, rents start to stabilize, and then landlords can start very slowly increasing their rents, very slowly. And then eventually the market reaches long-term occupancy average, which then takes us to phase two of expansion. So as demand continues to grow, vacancy rates continues to decline. And this is a signal that there needs to be more space, more units, because there's starting to be less available supply in the market space. So which means we can start thinking about new construction again, but we can't start just yet. So during this period of not enough supply, you'll start to see rapid rent growth. So as rent is increasing rapidly, we get to a point where it becomes feasible to start new construction, because now the NOI can start support construction again. But because there's a lag in delivering the new construction to the marketplace, demand growth for units still outpaces supply growth. So as history shows, we can have a very long expansionary period, and it can be a very long, slow uphill climb. So as absorption outpaces the deliveries of new construction, vacancy will continue to decline. And this is when investors start to feel excited again about investing and start thinking this is the best investment ever. You can't lose. So developers start to continue to keep building and building, but nothing lasts forever. So the peak happens when demand and supply are growing at the same rate, meaning you're absorbing the new units coming online at the same pace as they're being delivered to the marketplace, and then so you reach a point of equilibrium. So prior to equilibrium, you're delivering units faster than you can fill them, and this leads us to the next phase, hypersupply. So hypersupply starts after equilibrium. And more units are coming online faster than you could fill them. So right before equilibrium, your occupancy is at the highest, vacancy is at the lowest. So it looks like it's a really strong market. So unfortunately, investors and developers, they don't understand how to recognize when that peak and equilibrium point has passed by them by, and they continue to pull permits, they continue to build, they continue to buy land and start new construction, because all they can see is a really low vacancy, really high rent, really strong demand. But now we're at the point where more units are coming online faster than we can fill them. So supply growth is higher than demand growth, and this starts pushing vacancy rates back down towards the long-term average. You don't feel that much pain yet from oversupply, but all the units coming online are now starting to compete for tenants. and rent growth starts to slow down, and you might even see a trend downward in rents. And then eventually developers start to understand that the market is in a downturn, and then construction starts to, and then construction starts to slow down and maybe even stop. And so once we're past that long-term occupancy average and new supply still outpaces demand, we start entering the next phase, recession. So recession, the recession starts when vacancy rate is now above the long-term average, so higher than the long-term vacancy average. You have high supply growth, so new units being delivered, but very little demand or even negative demand, meaning people might actually leave the market entirely, because either they can't afford it or there's just too many units online. So just how bad the recession period is going to be depends on how much new construction is still being delivered or under construction. So now you have the new A-class units being delivered to the market, and very few are getting filled. Landlords are realizing they need to start offering concessions and start to lower the asking rents to get those units filled, or else tenants will move elsewhere. And this puts a lot of pressure on the B-class properties to lower their rents, to stay competitive, to be able to fill their units, which then puts pressures on the Cs and so on and so forth. So now the market is relatively illiquid, meaning properties need to be discounted in order to sell quickly. In a liquid market, a property can be sold pretty quickly without having to lower the lower price. So now the market is illiquid. You need to lower your asking price if you want it to sell quickly. And then the cycle hits rock bottom when all construction stops, or when demand starts to grow again faster than units coming online to the market, and then you start over again in the recovery phase. So back to the market cycle chart. So if you want to look at timing to put this in perspective, nationally in phase one probably puts you sometime in 2009 and early 2010. So down here you have very low rent and low occupancy, and then you can see the long-term occupancy is up here, and in the recovery phase we're very far down below. So
your voice is vibrating. Your voice is vibrating. It's not coming through clearly.
My connection. Can you guys hear me? Can you guys hear me now? Not good. Oh man. I need to first. Is this any better?
Yes, it is.
Okay, maybe there's something going on with my computer then. All right. So let's again, so let me start from the beginning again. So beginning of phase one, putting in time's perspective, is probably sometime between late 2009 and early 2010. Down here you have very low rents, low occupancy, and you can see it's very far below the long-term occupancy average. So as the phase goes along, as rents start to increase and vacancy decreases, your NOI starts to go up, but inflation still outruns rents. So down here in the beginning in point one, you start to get a little bit of traction. So now your occupancy starts to increase slightly. We may still be a little bit of negative rent growth, but demand for apartments is starting to show. So people are starting to fill vacant units. As units start to fill up, that starts to increase the rents. And as we continue up, we get to the point of the long-term occupancy average at 0.6. So now rents are increasing at this point and vacancy is decreasing. You probably don't have many concessions going on. Nothing is under construction at this point, so there are no deliveries. We're only absorbing units. We're only absorbing vacant units. We're only filling up the vacant units. So we have absorption without construction, which is why demand is starting to outpace supply. So as we go further up, now we're in phase 2 in an expansion. So once we get to the green spot here, 0.8, we're right about where we need to be, where rents and the pro forma NOI is high enough where we can afford to build. So the developers will start new construction around here, around 0.8. Down here at 0.6, even though we need units, developers can't afford to build yet because the rents aren't there yet. The rents aren't high enough yet to allow for that. You have to wait for until the NOI is high enough before you can build. So rents are increasing pretty exponentially up until this green dot here at 0.8, and there probably aren't any more units left to fill. So rents are continuing to drive up. So now the developers are building and then they start to deliver to the market. As we deliver to the market, as we start to deliver, the market starts to level off because as we get deliveries, units start to fill again. And as units fill, we start to level off again. So if absorption is keeping up with deliveries, we get to this point of equilibrium at 0.11 here where demand and supply is equal. As we continue to build, which we're still building at the equilibrium point here, probably still pulling permits, still buying land, still proposing. We continue to go under construction for the next 2 points, point 12 and 13, and that puts us in phase 3 of hypersupply or oversupply, where rents may still be increasing very slightly, but they started to slow down tremendously because now absorption is no longer keeping up with deliveries. And by the time we get to point 13 here, rents are now declining. Units are still delivering, but vacancy is increasing because absorption comes to almost a stop. And that drives us back down towards the long-term occupancy average and then drives us into recessions. Does anybody have any questions about the market cycle?
So this is not a national thing. This would vary from one market, and I could dare say a sub-market even could be going through this when, like you could have a main market going through this while the tertiary market is not going through this, correct?
Yes. So this is actually brings up to my next point. Yes, it's very market specific. So how do we find out where in our market cycle your particular market is in? So there is a report, the Dr. Mueller's market cycle report. I'm not sure if anybody have heard of that, but here is the website here to where you can find it. Let me pull it here for you guys real quick. Burns School. So Dr. Mueller is a professor in this University of Denver. If you go to that website here at the bottom, you can find his reports. You can find, and he releases it every quarter. Again, the website is right here. So So some of you and may or may not know about this, but a lot of investors and developers use this data to try to identify where in the market cycle a particular market may be in. But keep in mind, this only includes the top 50 markets in the country. So if you see something, if you see a +1, like Atlanta here, which is on 0.12, this means that in the last quarter it is at 0.11, and in this current quarter it moved up a point to 0.12. If you see a minus, you don't see a minus here. It means that last quarter it moved backwards in the cycle compared to the previous cycle, the previous quarter. So again, they publish this data once a quarter, but caveat, they published it maybe 2 months after the end of the quarter. So this data changes, and this data actually changes very quickly. So if you don't really want to depend on the report to find out where it is currently. And then I'll show you, and I'll show you later what is the metrics that you want to take a look at to see where in the cycle you are in. But here's the market cycle analysis chart for Q1 of last year, of 2022. Around 80% of the markets that he took a look at, of the top 50 markets, they're at equilibrium. So including the nation as a whole. And the majority of the markets that are in hypersupply just moved into hypersupply. So you can see most of them there are +1. Move on to quarter 2. It's mostly the same, but 2 markets moved further into hypersupply. Palm Beach and the darling market, Phoenix, Arizona. And then things start looking very interesting in Q3. So in Q3, things started getting getting a lot worse. So majority of the markets moved one stage further, and one stage further actually into hypersupply. The nation moved into hypersupply as a whole, and again, Palm Beach and Phoenix moved even further into hypersupply, even in the brink of recession. You see a whole bunch of, so this is what, maybe 20% of the markets moved further along into hypersupply. And then Q4 looks even worse. So about half of the markets moved even further into hypersupply. Look at all these markets that have a +1. And this includes the nation as a whole, moved further into hypersupply. And Phoenix, this darling Phoenix, actually moved deeper into a recession. So a lot of developers, if they're looking at this Dr. Mueller's market cycle chart as where they wanted to get their data from for whether they can continue developing or not, they're actually looking at it pretty. There's a lag when you're looking at this market report, and unfortunately, if they're looking at this as their data, then they might not have made the best decision in making whether they want to continue to develop or not. So so what you want to look at, if you want to look at really currently where your market is in a market cycle, it will be looking at that absorption rate. So your absorption, you want to compare your absorption to the number of units, new construction units coming online. If your absorption number is higher than the number of units that are coming online, you are in the expansion period. You are in expansion because you're filling units faster than the number of units that are coming online. Once you get to the point where more units are coming online, then when you have absorption, then that is not a good, then you're starting to move into hypersupply. So let's take a look at some of the data that you can get from from Costar. So this is data analytics. And this is analytics data that you can get in Costar. And in Costar, you can get it, look at it quarter over quarter. So what I look at, so this is Columbus. This is what I pulled from Columbus. I think I pulled this back in January. So you want to look at it quarter over quarter to take a look at trends. So let's take a look at effective rent first. So you look at Q1 2020, you started at 1147. Q2, great, you have rent growth 1186, but starting in Q3, you start seeing leveling off. The effective rent is now at 1187, and then Q4 you actually see a decline in rent, 1177. And this corresponds with the Dr. Mueller report. Let's take a look back at that. Oops. You see Q1, Columbus, you're in expansion, so you have rent growth. Q2, you're still in expansion, you're in rent growth. Now in Q3, that's when you started seeing a decrease in rent. You moved up into hypersupply, and Q4, you moved up again, moved up a stage in hypersupply. So you see even more rent decline. Then you compare that to vacancy. So you see vacancy, it was at 5.3. Q3 you moved up to 6.1, Q4 6.6. So you start to see vacancy is starting to increase. And then you want to take a look at absorption, under construction units, and delivery. So in Q1, you see you delivered 729 units into the market. Absorption, you absorbed 1,307 units, so that's good. You filled up more units than units that came online. And then Q2, you have 1,824 units that came online. Absorption, you filled 1,704 units. So you started seeing leveling off. You're starting to not catch up to the number of units being delivered. Then Q3, you delivered another 1,303 units, but you started losing. So the number of occupied units at the end of Q3 compared to the beginning of Q3, you lost 442 occupied units. So you started leveling off. You started moving backwards. And then Q4, you delivered another 786 units, but you lost another 309 units. So this is where you see the cracks in the. This is where you see the cracks in the market. But if you listen to your brokers, you take a look at in Q4 of 2021, your effective rents is 1120. But then at the end of Q4 of 2022, you see your effective rents is 1177. You see that they say you have room for rent growth year over year. You have rent growth. If you take a look at this and you put in your projections that you have rent growth of what is this 8%, but you look at it quarter over quarter, you actually see rent decline. This is a crack. You're looking at this trend, you're actually seeing rent decline. So if you're projecting that you're going to continue 8% rent growth year over year, your projections are not gonna, your projections are not gonna hold true when you start operating your property, because the market does not allow for it. All right. So do you guys see how important understanding this data is when you're underwriting a deal? So this is the type of information that you need to find out, because this is the information that you need to input in your underwriting assumptions when you find a property. If you're using the wrong assumptions, like what a broker thinks that is telling you year over year you have a rent growth, but quarter over quarter you see that rent is decreasing, that's a problem when you are trying to when you're trying to make your projections. So it's really important to understand this information. Robert, I see you have a question here.
Yes, thank you for the University of Denver resource. That was a new one for me, but I would like your opinion if you had one on the large area radius tool that's out of University of Indiana.
I've actually haven't heard of that one. I know that this Dr. Mueller one is the biggest one that everybody uses. I mean, everybody under the sun, they can create a market report. But I think Dr. Mueller might be one of the more respected sources. But at the end of the day, if they know what they're reporting, then and they're objective about it, it's fine. The thing with Dr. Mueller is you can see it on a pretty graph, but he also gives he does give an analysis actually on all the different classes of properties too, industrial, hotels, things like that.
Yeah, the large area radius tool is the slick drop down menus for lots of different data, but building permits, income, education, but yeah, I don't know what their sources are necessarily. So yeah, but one day I'll be able to afford Costar and I won't have to use that one.
Well, or you never need, or maybe if you find somebody who does, maybe become real buddies with a property management company or a go-to broker. Tell them I need to know this data. I don't want to just listen. I just don't want to take your word for it. I need to do my due diligence.
I'll put in a few more LOIs and I'll make that contact. Thank you.
All righty. So, anybody have any more questions?
I have too many. Hi, Victor.
How you doing, Cheryl?
All right, and you?
Good.
Good. Wow. Seeing all that data will really make your head spin after a day of pushing to limits. Okay, so is this kind of like this is the rent economic cycle, would you say?
Yes.
That we looked at?
So the market rent cycle or real estate market cycle. Yeah. So if you look at that graph, if you look at the
spreadsheet.
If you look at this graph here, yeah, so you continue looking up this line here, basically represents your NOI, and then you can see the highest point will be the highest NOI you would have. So and NOI slash rent. So the higher up you go, the higher rent you have. The lower down you go, the lower rent you have.
Oh, okay. And are you predicting that we're obviously going to be in the higher bracket right now?
I see that we're all we're in hyper supply already, 12 and 13. Even nation as a whole, we're Q4, we're in hyper supply already in point number 13. Sooner or later, if construction's still going, then we're gonna go into a recessionary period. A lot of things affect where things go. Interest rates is one of the things, external factors as well. So we'll see how things go.
Right.
Right now, we're definitely in hyper supply. We're definitely in a downward market now.
Oh, wow. Okay.
You can find ways to win in every single phases of the real estate cycle. You just need to know, you just need to use the right strategies. So in expansion and hyper supply, so in hyper supply, you need to understand if you buy, you need to buy long term. You need to buy long term fixed debt. There's no way you can get out of it real quick. In expansion, you see a really rapid rent growth. People start buying and selling it real quick, buying like and holding it for only 2 or 3 years and selling it because the market is on their side. The rent growth is on their side and they want to make a quick buck.
Turnover, yeah.
Yep, yep. But then in hyper supply, you would need to understand, you would want to, you need to understand the fundamentals of underwriting, you the fundamentals of buying a cash flowing asset and buy it for cash flow, not for appreciation.
Wow. Okay, yeah, I have to look closer at this later, but makes a ton of sense. Thank you for explaining better.
Cool.
So for the hyper supply phase this year, we're going to look at more long-term growth strategy.
If you were to buy, understand you want to buy for cash flow. It needs to be cash flowing, and you can't bank on appreciation anymore. So you would need to hold, I would say 7 years, 10 years until the cycle gets back to
more normalcy.
Before normalcy on an uptrend, before you can truly exit the deal.
I see.
If you were planning to exit in 2 or 3 years, that it's not, the market is tanking, is going further downwards. You're not going to be able to exit.
Right. Well, educated investors know that it's usually a longer game that you want to play.
You would
Right?
hope so, but unfortunately, in the past 2 or 3 years, a lot of gurus out there, they've been educating students that you can overpay for a property. The market is coming to you, because it was for the last 7, 8, 9, 10 years. The market has been on their side. Take a look at interest rates were continually to decline year after year, historic lows after historic lows. What's that gonna do to property value? People can pay more because the cost to borrow money is cheaper, so you can pay
Yes.
more, and then that's what happens. And then unfortunately now, when interest rates increased so much due to external
Inflation.
factors,
Mhm.
into the external factors, now everybody's in a pickle.
Right. But not if we're getting this content. It's gonna really give us an advantage.
Yes.
At least like to have
understand how real estate works, how real estate market cycle works, to help you not get in trouble. All the people that did not understand, they got in trouble.
Right. So don't bite off more than you can chew. Would
Yep.
that be safe? Okay.
Yep.
Thank you.
All right. I think Mary, I saw you had a question earlier. Hang on, let me unmute you.
Okay, is this good?
Yep, I
So
can hear you now.
my question was, when I had my hand raised, is that when you say long term, what do you mean by long term? And you answered 7 to 10 years holding, correct?
Yeah.
So
At the very least 5 years. Ideally over 7.
Okay, and are you saying during this time you want the property to be cash flowing, correct?
You would want to buy a cash flow property. Yes. You
Okay.
want to buy it. You want to buy it for the cash flow.
Beautiful. So what do you think of investments where it's now a hotel that's being converted to a multifamily, or like a home that has extra land, and now the investment firm is developing 12 units or 20 units on this land? What are your thoughts on that?
But that's going to be a really risky investment
Risky.
then. Yeah, because you don't have any cash flow coming in. You're purely buying on pro forma, because you're only you have to project, you're projecting what rents will be when you're finished constructing, right? Especially on a conversion, you shut everything down. So that makes it a lot riskier. More savvy investors that understand it might be able to might be able to do it, but the market is not on their side. They might not
Mhm.
even, they might even end up halting construction until
Okay.
rents start rents start growing, and that will support them completing their project.
Cool. And then in this scenario, like when you have such investments, I came across acquisition fees and then they were pretty high. So apparently acquisition fees goes to general partners, correct?
Typically, yeah, the sponsors that put together the deal,
Okay.
that's
And
like
then,
their fee for doing all the legwork.
okay, at what time of the investment does this acquisition fee being dispersed? The time they're collecting money from investors or when this investment is being built and now it's flowing? When do they collect?
So there are different asset. Oh, acquisition. So you said acquisition fee.
Yeah.
Acquisition fee is at closing. So if you have a certain percentage at closing, so that comes straight directly from your investors. So the investors are paying
At
the
closing.
sponsor. Yeah. So
Wow.
they pay
Mm.
the general partners, the sponsors for bringing the deal, closing the deal. And then you have asset management fee, which is
Mm-hmm.
the members that are responsible for running the deal. So
Okay.
the investors, the limited partners, they don't deal with the day to day. They don't deal with managing the property. They're solely an investor getting cash flow. So they pay a fee for the members, the general partners, the members that are actually managing the deal.
Okay, which is fair, but I'm just thinking acquisition fee should be something that's actually not paid on closing, should be something that's paid when the property is now cash flowing since it's all pro forma, don't you think?
Well, unfortunately, that's what the model is. That's what the model. The acquisition fee is at closing. Because they're doing the legwork, bringing the deal to close. They find the investors. They do all the due diligence.
Mhm.
They find the loan. They put everything together. They find the property management company
Okay.
to run the deal, to take the
Okay.
deal down.
Okay. Okay. I see. Percentage wise. Okay. Thank you so much for answering my question.
Okay.
And thank you for sharing Dr. Muller's market cycles report. I'll study that a little bit more thoroughly this weekend and see what it's about. It's very interesting. I didn't know such report exists. Yeah.
Yep. So, all right. So, it wouldn't be a Victor Zoom if I don't leave you with any homework. So, you guys, to continue with the homework that you guys took a look did in session 1. So take a look at a market, an MSA. Identify which phase in the market cycle your market is in. Looking at the Dr. Muller's report. You want to research the population data on census to be able to calculate the demand and supply. So you want to take a look at the total population, the renter to owner ratio, the average household size to calculate this information. And if you want to take a look at, be even more forward thinking, talk to a broker or property management company to find out what is where is the vacancy trend going? What is the long term? Where is the long term occupancy average for your market as well, to see truly currently where in the market cycle your market is in. All right. So if you guys took some value from today's section, I would really appreciate if you take a picture, post this on social media, post this on our Facebook group, to show just how much value you guys got. And we'll see you guys in the next couple of weeks. I think next Wednesday we'll actually be alternating with the Miles for the financing and debt market. But and then tune in on Sunday. And our activation Zoom, we're actually having Alex Lovely from Legends Equity Group coming on our Zoom. He runs deals in Vegas, and he's a pretty good guy to hear from as well. So with that, I'll leave you guys good night, and then I'll see you guys next time.